Hello guys, this is Aryan and welcome back to Stock Market University. Today we're going to be continuing on the candlestick and trend line patterns video that we did before. This is the second part in that series. It dives into a bit more complicated patterns when it comes to candlesticks and trend lines. And yeah, let's just get started. What you can do for that is usually when you make a pattern with a few trend lines combined, they form they usually have greater chances of success as trades than just following with one candlestick or one pattern like a bullish or bearish hammer or engulfing candle or the like. So let's try to find one here. Now what we're looking to do basically is connect the lows and highs of a particular set of candles to try to form patterns. Now there are a few patterns that are widely recognized and followed by people, which are the ones that of course work best because as in the financial markets, how it works really is the more people that follow a particular strategy or a trading system, the more likely it is to work because more people following something is basically equivalent to more money in that direction, right? So, hmm, what I think I see here is if I take this top, lay it on the next candle it touches, which is this one, that's also sort of interacting with candles up here. So, this is it's a long-term sort of trend line. It is pretty strong. Now, this happened in the past, of course, because these huge trend lines, they usually take some time to develop, but when they do yield results, as this one did, now the results are pretty fruitful, as you'll see here. Now, what does happen is sometimes there are fake breakdowns like this one. The trend line first broke to the downward level, took support here at uh, previous supports around 150. That's also a psychological support there, and the price must have interacted with that level somewhere in the past. Right here, see, this is why it took support later on, because of this interaction here in the past in 2020. So it took a support. So yeah, this pattern here is a symmetric triangle pattern. Whichever side it breaks out to, usually you can expect a big move. Now, as we discussed, this one did give a fake breakdown, but your stop loss, if you did trade this breakdown, would have hit pretty soon, somewhere around here. And when this did cross upwards again, because there already had been a fake breakdown as well, which was rejected, the bullish momentum that came after it was even greater because of this fake breakdown, which is something you can follow into as well. And you'll see as well after it started you know going back up into the pattern after the breakdown, the volumes were increasing here, the price increasing, volume increasing as well, like we discussed in the second episode as well. Price continued increasing along with the volume. Here the price is increasing, volume is also clearly increasing, and it's above the 200 EMA for a good bit of the time, almost half the candles above the 200 EMA, which is of course a good sign, great sign for momentum, which we saw play out here clearly. Now I'll move into the 5-minute chart just to find more patterns to play with because those they do form more easily, of course, in intraday charts. I'll go to the Dow Jones for this, just because it has a clearer pattern and patterns and momentums in short time frames because it is of course a huge index, a huge market cap behind it, so it does not move easily. Now, as we see here, I can see one right here. This is just called, you can call it a rectangle pattern because you see this, it forms almost a simple rectangle here. And you could scalp this intraday, which I do not recommend myself too much because the profit to gain is small. And by scalp, of course, what I mean is short it whenever it touches this top line here and buy it whenever it touches the bottom line. You can see it worked a few times here intraday on the 22nd and 21st of November. But when it did break out finally, if you would have shorted here and took the position home, you would have suffered big, huge losses here on the opening on the 23rd. Sorry about the timing here on my graph. You'll see in the bottom here is kind of messed up because I'm living in the UK. I'm tracking American charts, and the clock on my PC is actually set to Indian time, for various reasons. But yeah, so when it did break out on gap up opening, you would have faced a huge loss, which probably would have wiped out and even more than wiped out all your profits that you made here scalping this for a day or two. Anyway, so the Dow Jones. That's a rectangle pattern. It was closing up a bit, so it could be called, if it did continue all this way, I mean, it would become a ascending triangle at some point. The last pattern we saw was a symmetrical triangle, which goes like this. Now this one is equally bullish and bearish. Either side the breakout happens, momentum is confirmed. For a pattern like this, and if you did draw this out like I did, matching the lines completely, instead of just what some people would do is, go here and they would grab, hold on, they would just grab a rectangle and try to fit their expectations to what they see all of a sudden. And this does look like a rectangle when you look at it. But if you do, and a rectangle, of course, is like a symmetrical triangle, up or down, wherever the break up, the breakout or the breakdown happens, take a trade in that direction. But if you actually connected the dots clearly and took your time with it, you would see that it's a long ascending triangle in formation, which is actually a bullish pattern. And as you can see, the bullish pattern did pay off here. Goes up here, usually breaks out a little later. This one broke out sooner and it did pay off quite well. Dow Jones close to an all-time high nowadays. Pretty damn close, I think like 700 points to go or something like that. Now, of course, that was an ascending triangle. The opposite of it would be a descending triangle with a trend line coming down like this. This is just an example, so don't look at the prices. I'm just trying to sort of give you an example because I haven't found it yet and I don't want to miss out on this. This would be a descending triangle with, let me just draw some candles for you. Price action would be something like this in here. Touch that top, touch this bottom, touch that top again, touch this bottom, touch that top, touch this bottom, and usually have a breakdown because, of course, this is a descending triangle. The highs are getting lower and lower, and the low is staying the same. High is getting lower, of course, there's more pressure from the top side. That again, of course, is a very simple and important factor in price action analysis, which is that whenever there's higher highs, there's more buying pressure, higher lows, there's more buying pressure at the bottom as well, as we can see something like that forming here. Higher lows, higher highs, which means continuing bullish momentum. Now, if we saw something like, let's go try to find some lower lows somewhere. And this, if you notice, is this concept of higher high and higher lows is what plays into the triangles. to give them their properties of being bullish or bearish, like an ascending triangle here with the trend line coming up and a flat top. The lows are getting higher, more buying pressure from the bottom, buying pressure from here, selling pressure up top here because the top is flat, but eventually it's expected to break out because this is staying the same. They're not able to push this down, but the sellers are not able to push down from here, not make the highs lower, but the buyers are making the lows higher and higher, which is of course a bullish sign. All right, let's see what else we can find here. What else sort of kind of patterns we can find. This also is a decent strategy to trade. This one right here. What's happening here is, if you'll see, you connect these dots, you'll see a lot of sort of candles moving in the same general direction with a few trend lines guiding them up top and a few trend lines guiding them at the bottom as well. This what's formed here, if we sort of clean this up and only keep two of these lines, keep the broader parameters away for now, just to keep it simple. These are following a pattern of higher lows. There was a bit of a fall here, but it recovered. Higher low again and higher highs, as you can see, higher high, higher high, higher high. This is called a rising channel pattern, where the highs and lows are both increasing in a pretty constant pace. You can trade these by, say, buying whenever it touches the bottom price and wait for a reversal. It did break down here, which you might hit a stop loss. You can hit a stop loss in any trade, and we'll talk about trading psychology, the stop losses, taking profits, what kind risk management and stuff like that in future videos as well. But for now, let's stick to the technical aspect of it. So you could buy these bottoms here and make a decent profit. And if, of course, any trend line can have breakouts, so if you did buy these bottoms, you'd make a decent profit up to these highs. But if it did break out successfully, which it tried to do here in a small rectangle, but it couldn't, it actually broke down. If it did break out above these levels, however, you could easily see a move of, say, 100 points, 200 points in a very short period of time because of the sheer length of sheer length of this pattern here, the rising channel that was drawn out here. What else? Double bottoms and double tops. Now, if you guys want me to go more in depth on some of these patterns in particular, feel free to, leave them down in the comments. I'll try to figure out what I can do with them. Maybe make a short video explaining them more in depth for whatever patterns you guys are interested in. This one right here is a double bottom. See, the bottom is in the near price is same price range for these two separate time spans candles. One bottom here on 14 November 22:55, around the same price bottom on 15 November, the very next day. And this gave a pretty decent bullish momentum afterwards, after the double bottom was formed. Now, the same scenario is played out right next to it, in fact, here with the double top. Now, this one, the price difference is a bit larger. Actually, it's about the same, but yeah, it also did give a decent move, but it did not sustain for long. Now, if this was an future of an index, we could actually see the volume as well and maybe add a few other indicators to, of course, give a more clearer signs to choose whether we want to trade the double bottom or the double top. But either case, that worked out pretty well. You would have gained some good profits in intraday at least, which you could book both from this double top formed right here because of this top here. You found another top, you take the trade when this top, the second top was formed, and it started the downward momentum from here and it went down quite a bit. You'd also trade this double bottom in the same way. The first bottom formed when the second one formed at the same price level and started showing bullish momentum, you take this trade. And when it broke out, of course, above this trend line of the double tops, saw more bullish momentum as you'd expect. All right, guys, that's it for the second part of the candlesticks and trend line patterns videos. I will make more videos on this topic, but that will be in the future because the patterns that are left really, some of them by name would be the cup and handle, head and shoulders patterns, and the Fibonacci level patterns as well. Those are more advanced topics, which I believe would be better done after a few more of the basic concepts have been covered. So, yeah, that's about it. Thank you guys for watching. Let's continue learning together. If you like this video, please do like and subscribe.